What's going on, everybody? It's Jeff here. Welcome back to the channel. All right, 2021 is coming to an end, and the closer we get to the new year, I see an increasing amount of articles and video thumbnails talking about the monster market crash of 2022. So in this video, I want to give you my opinion on the current state and health of the market that we are in right now. Also talk about a few catalysts that might have a negative effect on the market next year. And then lastly, I want to give everyone an entirely different perspective, one coming from a very valuable and costly lesson that I learned this year. So in this video, I'm going to break everything down. Let's get right into it. First off, let's take a look at the S&P. This is the SPY. It is up a total of 30% for the year. Now, at the end of March, we are coming to the end of the second year of the bull run. And naturally, the second year of a bull run, the market has an average return of about 16%. So if the market continues to go another 2%, we have exactly doubled. And this looms the big question: how much more can this go? There are a few big concerns. The biggest, in my opinion, being inflation is beginning to run rampant. The second being you have interest rates that are going to be raised as of next year. And the third being not only the Omicron variant that is ahead of us right now, but also any other COVID variant that could happen throughout the entire next year. So let's first talk about those things. And this article has a couple things highlighted. But before we get into this article, I want to talk about Jerome Powell and the Federal Reserve. Now, I know a lot of you are thinking that whenever he talks, the market tends to pull back a little bit, but they have done, and him specifically, have done a great job caring about not only the economy, but more importantly, the stock market. They've kept the stock market continuing to make higher highs. So let's talk about the rate hikes first, which investors are eyeing. Right here, economists said the rate hikes could begin as soon as March, but some expect economic weakness to push liftoff until summer. That gives us at least 3 to 6 months before any negative effects of rising interest rates. The next is going to be inflation. And he's already decided to taper the asset purchasing, which is going to slow down the inflation as well. But he states right here, we have to make sure that higher inflation doesn't get entrenched. It's one of the two main threats other than the pandemic and getting back to maximum employment. So basically what he has said is that they are going to raise interest rates as slow as possible unless inflation continues to be a little bit too rampant. Okay, meaning we have an offset to that. Now, in the short term, this could obviously cause a little bit of a pullback and a little bit of a dip, but they have a plan to be able to fight this. And like I said, pending anything crazy that happens, which is always could happen, we have to go with the news that we have right in front of us. Now, lastly, before we talk about the perspective, here was an article that was released today. The CDC lowers estimate of Omicron prevalence in the United States. And I also do believe that they lowered the quarantine timeframe to be 5 days as of now. So this is good news when it comes to any lockdown threats, return to normal, and so forth. Okay, so keep that in mind. Now, I want to talk about this, a very valuable and costly lesson that I learned, this year. And so back in, and if you've been following for a long time, you are very aware of this, but back in pretty much June of this year, in July and August specifically, when inflation was starting to become rampant, we had worries of the debt ceiling, had run out. What was this government going to shut down? In September, we had the first news that Evergrande was going to default. Okay, the economy, you had unemployment going down, but people weren't going back to work. There was still stimulus. There was a lot of red flags happening. And if you're looking at this chart, I'm talking about Tesla because I cut a lot of positions in my long-term portfolio, Tesla being one of them. Now, before we talk about Tesla, there are a couple of them that actually saved me a lot of money that I actually got out of at a higher position than they are now. One being DraftKings, another one being Neo, another one being Upstart. You can't forget Palantir, which I'm still bullish on Palantir long term, but Palantir as of right now. But when you look at a couple other stocks that I'm going to show you. Okay, these are positions I had that were very large, comparable to my portfolio. I got out of Tesla at about 780 when it started to pull back in about March. All right, when the EV sector was just so hot for so long, I ended up getting back into it at about 600. Which, when you think, okay, you doubled your money, yep, nope. But I was a little bit fearful of the market come September, so I ended up getting out of it at about 750 and missing out on a massive gain to the upside. All right, look at NVIDIA. I don't even want to talk about it. You can just see by looking at this chart right here. Look at Apple, which was probably one of the biggest positions I had. I don't have to tell you. You know by looking at this chart, I missed out on some massive gains. All right. Lastly, Costco was one I talked about in the Easter rally. All right. And they ended up getting out of that one as well. Same thing. My point behind all of this is you're never going to be able to time the top. People have been doing it, trying to do it for years. Think about Michael Burry. I mean, how many, and everybody else who's a bear out there. Seems like every week, every month for so long, the market's going to crash. The market's going to crash. The market's going to crash. Now, I remember back in October, okay, of 2020, when the market just recovered way too fast. We had that big pullback. All right. And this is on the weekly chart. We saw it. We hit a double top and it started to pull back again. And I was like, uh-oh, here we go. Like, it's got to be. There was so much talk about the market just being way overextended. The government was printing all this money, all these bad news. And here we were when the SPY was 330, and now we're hitting all-time highs for the, 70th time or 69th, 70th time this year. 70th time this year. And here we are at 480. And when you think about how much you miss out on based on fear, it really puts things into perspective. Now, like I did just say, I did get lucky. I did shift a little bit more money over into my day trading and swing trading portfolio. But as the year ends and I really start to break things down, not only did I spend more time in front of my computer, I actually made less by getting out of those positions. Now, I'm not saying, go buy Costco because I missed out on it. I think it's going to go higher. It can get to 700. Go buy it right now as it just hit another yearly high as of today. But being able to buy this on the dip, as you can see here at 538, 540, and give yourself a comfortable cushion if you feel at least there's a good pullback happening, is a great way to continue to play. Okay. So this is not only my strategy for 2022. I'm going to break down an entire other video for you talking about this strategy more specifically, but I also want to relate this in a little bit bigger of a time frame because this one hit home to me. So I am involved in real estate. I bought my first real estate investment property in 2015, and I was young. I was 24, 25 years old. And maybe if you are a realtor or a loan officer, you might have a different perspective than I did. But like I said, I was young. And a lot of people that I was talking to, I was reading these articles all over the internet before I actually knew that they were paid by, but paid incentives. I thought I was getting in at the top. And I had said to myself, because this was going to be, this property was going to be a little bit different. I didn't really want to hold on to it for too long. I didn't know what was going to happen. I wanted to be able to get out of it within a few year time frame. And I also didn't want to take that big of a hit. But I was very, very nervous. And I wanted to buy in 2014 and I didn't. And I remember I had that mentality of, oh, it's going to crash, it's going to go down, and I'm going to buy the dip because I have more money. And I wasn't able to do this in 2010, 2011. And when you're looking at the US housing price index, check out where we were in 2006, 222, 223. And if you look at where I bought in 2015, we're at 216, 219. So it's almost kind of in that same time frame. And it was a very similar thing happening, that it just recovered a little bit too quickly. Loans were, being handed out a little bit too easily. Now, yes, it was a little bit different than the 2008, MBS crisis. I understand that, but it was still a lot of talk happening. And my point behind all of this is I would have been sitting here right now going into 2022, okay, having purchased no properties because I continued to buy all the way up until December of 2019, right before the pandemic. But I'd still be sitting here like, yeah, I'm waiting for the dip. I'm waiting for the dip when that property has already gained about 40% in value, let alone the amount of rental income I've gotten to be able to also pay down my mortgage and so forth. So, like I said, this is just a different perspective of when you're trying to time the top. For years, everybody is going to time the top. Your investment strategy might have to be a little bit different. I do wish I looked back and still maybe shifted a little bit different to what stocks I invested into. Obviously, high growth, but your blue chips, like the few I just mentioned, continued to rally. So my point behind all of this, this entire video is one, we're never going to be able to time the market perfectly. And if you do, you're just getting lucky. And like I said, don't fight the trend. And when you look at the chart of a longer time frame, the trend continues to go up. And we might have a 10% correction, which is natural, but it's going to recover. Even if you look at the 30% drop that happened, in March of 2020, we came back to that in no time and continuously ripped higher. Okay, so in longevity, the stock market continues to move up. So just think about that. I hope that gave you a little bit different of perspective. And like I said, guys, that's it for this video. I'll see you in the next one.